Welcome back to Basic Business Training Part 2, and we are now entering the last part of our management to look specifically at sources of funding. Before we get into this particular subject area, let's look at a text and spend a little bit of time in Galatians 6, verses 7 through 9. And Galatians 6, verse 7 starts by saying, "Do not be deceived, God cannot be mocked. A man reaps what he sows. Whoever sows to please their flesh, from the flesh will reap destruction. Whoever sows to please the Spirit, from the Spirit will reap eternal life. Let us do not become weary in doing good, for at the proper time we will reap a harvest if we do not give up." And there are a few different principles that I want us to look at as it relates to this text. The first thing, of course, is we know that when we take a seed and we plant it, that seed goes into the dark. But the harvest will not stay in the dark. And so we have to think about the seed that we're planting and recognize that what may happen in the dark may eventually come to light, and we want it to be something that is good, that is pleasing, and that will reflect well on the Maker. The second principle is that the harvest will always be the same as the seed. You can never plant maize and reap beans. And so you have to be careful and think through what it is that you are planting as you are doing your business to be sure that when the harvest comes, you will be able to enjoy it and be thankful and be glad in it. And the third principle is that the harvest will always be bigger than the seed. You can't sow a seed of corn and just get one seed. It is always bigger, and so we need to again be careful what it is that we are sowing. How does this relate to sources of funding? Some of the challenges that we get ourselves into is when we are not considering all the different ramifications of things that can grow. When we think about the seed and the harvest, we think about farming, and it's a good and a beautiful thing. And we see this exuberant God who we plant one seed of corn and we get ears of corn with tons of seeds. But sometimes the things that we're planting are not always good things, and we think that we can keep them in the dark, and then they come to the light, and it's a challenge for us to continue to deal with it. And our reputation becomes damaged, and we have to now figure out how can we be standing in front of God as His person running His business in light of the community and those that we have been seeking to help flourish. And so it's a reminder for us that we need to be very careful of all the different things that we are sowing. And sources of funding is really something that I have seen people trip over a great deal. I've been involved in a number of different loan programs, organizations that give loans, and it's always something that we're excited about. It's very exciting to train somebody to do their business well and to the glory of God, and to see them develop a good business plan. And then the day comes when they are so excited to receive their loan, and they have a way of how it needs to be implemented. And then somehow, often, things go a little bit off course, and we end up having significant challenges both in terms of a relationship in the business, in terms of being able to see the growth, the harvest that we were hoping to see. And so I wonder for you, what are the challenges in your context as it relates to sources of funding? The World Bank, again, assesses every country in terms of the ease of doing business. And one of the things that they assess is how easy is it for you to get funding in your country. We find that in some countries, it's very easy. And sometimes it's because there's many different savings and loan associations. There may be community-based associations. You may be part of SACCOs or merry-go-rounds or whatever it is you call them, village savings and loan associations. And so it looks like it's easy to get access to funding. But oftentimes some sources of those types of funds are part of the informal sector, and so the interest rate is very high, and people are paying a lot of money to access those loans. Banks, on the other hand, formal banks are more difficult to get loans from. You have to have a registered business. You have to provide several years' worth of balance sheets and income statements, and you have to have collateral to back up that loan. And so how is it for you and in your setting and in your country and for your fellow business people as well? Another thing to ask yourself is there a culture of savings? Is there a culture of savings in your country? Because savings, of course, is one of the ways, the best way for you to fund your business is by making sure that you have built up savings yourself to be able to replace things and to buy the next product that will help your business to go further. For some countries, there's a very large culture of savings, and for others, there is not. For many years, the United States was at a negative savings rate. It meant that we, on average, spent more money than we actually earned, and so we were running at a negative savings rate. For many years, China has had the highest amount of savings in the world, and 40% of their savings their income was going into savings. And there are many studies that show that those who have very little income are actually better at saving than those who have access to more income and a lot of forms of credit. And so what is your culture of saving? What were you taught as a child in your home? What are you doing as an adult and as a family? And what is your business doing? Because your business is going to survive if it has any problems based on an emergency savings that you have. And as we've talked about depreciation or setting money aside for the replacement of items, that will come through in your savings. And if you do not have it, then you might feel forced to get a loan, and that will cost you more money in the end. The third question is there a culture of loans that are used for consumption? And of course, when we're talking about loans used for consumption, we're talking about loans that are taken that you are eating the loan and then you have to pay it back with interest. And by eating the loan, I mean that you're putting it into something that is not going to give you more income. It's not going to actually increase your capacity. Some very common examples of loans that are used for consumptions are loans that are taken for weddings. I was just with somebody and they were talking about their own wedding, and my own children are having their weddings right now, and I think my daughter's wedding is going to be large with 200 people, and they said, oh, that's very small. We had 1,500 people at our wedding and we had to take a huge loan. And so you may be in a culture that has some demands for how big the wedding might be, and what happens when you take a loan for a wedding is it basically is a loan for consumption. You aren't making anything off that wedding unless you have very generous gifts that are coming in. And other places, other countries that I've worked in are taking loans for funerals. And again, that's a big challenge because you have to pay that money back with interest, and of course you're not making any money on that funeral. And so it ends up being something that costs you even more as you do that. Some of us take loans for Christmas gifts. Some of us take loans for school fees, and for that as well, we will get a payoff when our children are adults and they can get good jobs. But is there a way that we can do savings, that we can treat savings as an expense in order to not have to take the loan that will be used for consumption? And so I want to talk about some different types of sources of fundings that you can look at, different options, and then also some criteria for what different institutions will look at as it relates to loans. The first, of course, as I've said, is personal savings. And as you've gone through a budget, and hopefully you are working your own budget, we want to treat savings not as whatever is left over at the end of the month we will save, because that never works, but we want to treat savings as an expense. And the goal for the family, the goal for the business is to have 3 months of your fixed cost in savings. And remember, we said fixed costs are those things like your rent and your utilities, things that you have to pay no matter what. And so if something bad were to happen, that you could function for 3 months and be able to keep the business open while still being able to pay off those that you pay on a monthly basis. And so making sure that you are savings. And as you are thinking about the thing that you want to buy next for your business, how many months will I need to save in order to make that happen? How much interest will I be able to make on those savings, and so on? For a lot of people that are involved in Village Savings and Loans, that is why they join the group. They don't necessarily want a loan for themselves, but they want to earn the interest, which can be at a higher rate there than in a banking system. And so you can look at those different options that might be available to you. Another source of funding is of course, friends and relatives, family members who might be wanting to sponsor you in your business that you are doing. They may be willing to give you a loan, but maybe it will be interest-free. And so it's a much more affordable type of capital that will allow you to invest in your business. And family is often happy to do that. You have to make sure that there are no strings attached that will tie your hands in some other ways. But it is an option that you can look at. Just be sure that you make sure that the friendship and the family stays first, because we don't want that to spoil in the process. Bank loans, of course, varies from the types of businesses that they will give loans to. Is usually from the small and the medium to the large size businesses. Usually not the micro, which micro businesses are usually considered to have less than 5 employees. Small businesses have about 5 to 500 employees. Large businesses have more than 500. And the banks are typically helping those in those ranges from small, medium to large, and not the micro businesses as much. And so there are fees that you have to look at. There is collateral that you have to look at. But it is a good source for loans, and often has a lower interest rate than microfinance institutions, or, of course, the private money lender. So microfinance institutions is the next level. If you can't get money from a bank, you might be able to go to a microfinance institution, also called an MFI. And those are good options if you don't have savings. Again, the interest rate you pay is going to be higher there. And the reason it's higher is because they tend to lend to businesses that are viewed as a little bit riskier. They are not as grounded. They do not have as many assets. They do not have as much risk, or I'm sorry, they have more risk because they do not have as many assets. And so it costs the microfinance institution a little bit more money for them to work with micro businesses. They often go out and collect the loan payments, and so there's more manpower that's also involved. And so that's another option. If you don't have access to a bank, you can go to a microfinance institution. The next one is where we would say it's more the informal market, and some people call them loan sharks. These are people that give money at very, very high interest rates. And one of the things that's a growing concern as I hear about what people are doing with loans is that people are taking loans on their paychecks, that they are taking a loan advance, a paycheck advance. And they often pay very high rates of interest to pay that money back. And so what happens then is you're not managing your money well if you are taking an advance regularly on your paycheck. I understand if you have an emergency, if there is a crisis that you need to help somebody with, but to take a regular loan as an advance on your paycheck, it means that you are just running behind constantly. You're not doing your budgeting, and you are throwing money away that you have rightfully earned in paying interest because of a lack of management. I've heard of many people who are paying as much as 60% per year. Oftentimes these places are charging 5% per month, up to 120% interest per year is what I have heard people paying. And that is really, it's not a stewardly way of using the resources that God has given. And so what we have to look at, again, a source of funding is management of your budget. If you are taking a loan regularly for school fees, what is the thing that you could do to be able to get ahead of that process so that you don't have to take a loan? And it may mean sacrificing, really tightening your belt for 3 to 5 to 6 months so that you can get ahead, so that you can begin to pay cash on things and then not have to go into debt. Another source of funding is government programs. This is not always a frequent source. But sometimes governments do have programs that are available, and they will give grants or they will give loans at very low cost. Sometimes it depends who you know and in order to be able to get access to that, but those are good things to listen to. And again, if you're part of a cooperative, if you're part of a community-based organization, you will hear about some of those opportunities, and as well as talking to the different ministries that may be giving those out in your community and in your locality. Sometimes they are federal, but sometimes they're also at a state or a county level. And of course, the last one we want to look at are investors. And these are, if your business is growing to a certain level, you may encourage people to become investors. It's not as common, certainly not at a micro business level or at a small business level, but as you begin to grow, you may find people who are willing to invest, and in return, you give them a part of a profit, the profit that is earned. And so they become a stakeholder in your business. At some point, they may demand, it may be that you pay the investment back in full. It could be that they also are a lifetime partner. You have to work out with them what that will look like. But that's another source of funding that can help you in your business. And so the thing to realize is that they say most people, most businesses need 4 to 5 loans, 4 or 5, not 45, 4 or 5 loans to help them really be able to grow their business and to be competitive. And it makes sense. I mean, we need access to capital. And as we grow our business, we're talking about moving to the next level in terms of proficiency. In order for us to stay competitive, especially if you are in a place where you are seeing foreigners coming into your land, they may have an easier time getting access to credit, to capital, from their own governments than you do. And how will you compete with them except by also getting a loan? So a loan for a business can sometimes be a good thing, and it can help you go in the right direction, but we have to be very careful how we approach loans and how we use them. I remember I was working with a woman who was running quite a good business, and it was exciting to see the good things that she was doing, and she applied for a loan, and she got one of our larger loans. And it was good to see, and we were excited to see how she was going to use it. Well, unfortunately, about within just a couple of weeks of receiving the loan, her mother passed away. And following that, about 3 months later, her father passed away, and the entire loan went to bury her parents. And it became something that was very difficult for her, and the business ended up collapsing as well. So we have to be very mindful of how we go into having a loan, how we apply it, and what are the boundaries. How are we going to protect that loan to make sure that it is something that is a blessing and doesn't end up something that is a significant challenge. And so we want to talk a little bit more about how loans, where they come from, what are the advantages, what are the disadvantages, and so on. A loan, of course, is borrowed money. They help a business meet their goals. They can be an effective tool to help the business grow if it's used wisely. It can help, you can use the loan to help yourself buy a larger inventory or to be able to buy things in bulk. We hear of many people now traveling to Turkey or to China or to India or wherever to buy goods in a higher quantity, which is able to bring the cost down for the customers. It also enables a business to hire employees to expand the production or the services that it provides. If you hire new employees and you're expanding your production, a loan might help you bridge until you have enough productivity that the revenue is coming in and you are able to pay the employees fully. It may give you the bridge that you need. And of course, it allows you to, as owners, to buy the equipment that will allow you to grow. And equipment is always a good investment because it's capital that you have right there. It can serve as the collateral as well. Borrowing a loan can also have challenges and disadvantages. The extra capital can tempt the owner to live off the loan. So using the loan for consumption is a big temptation. The owner can be tempted to buy non-essential items for the business. I've had a number of people who have applied for loans and they actually wanted a loan in order to get a building for their business. And a building is a good thing if you don't have a building, but you have to know that you have the customer base who will help you to pay for that building, because suddenly you have a payment for something that you didn't have a payment for before. So a marketing plan has to go in with that so that as you move into a building, you should be able to know that more customers are going to come to offset the new monthly payment that you now have. And so you might be tempted to buy non-essential items for the business. And the owner might also be tempted, as I mentioned before, to spend the loan on family needs. The other thing that's interesting is that the owner might not be ready to manage the increase in money. And there's a part of the Bible where the Israelites are entering into the promised land, and God tells them that I will not wipe out all of your enemies at once, because if I do that, then the wild dogs will come in and you may be overcome by them. And I like to think about that in terms of the loan, that we are to grow small. We don't want to grow too quickly. If you grow too quickly, you might not be able to manage it. You might be overrun by it. And so small growth is actually a good thing. And one of the things that we look at as we give loans is usually not to loan more than 20-25% of the total value, the total net worth of that business. And so sometimes we will have somebody who has a business that when they do their balance sheet and they do all the assessments of what the business is worth, maybe it's worth a total of $1,000 US, and they're asking for $3,000 US for a loan to buy A, B, or C. And so it's much, much higher. It's 3 times the amount of what the value is currently of the business. That's too much. And so the general rule of thumb is that you want to ask for about 20-25%. Even that's a little high. Formal banks might go lower than that, of the value of your business, so that you can have slow growth, you can learn to manage it, you can grow with it, and hopefully that will be success on many different areas. The other thing is that the loan might prolong the life of a struggling business when the better option is to shut it down. You know, everything has a lifespan, and sometimes things need to die. We know in forests that if there's a forest fire, it's often burning out the brush, and it can be a good thing to allow new life to come in. And sometimes things are struggling, and it's time to let it go and to try something different. And I'm not advising you, so please don't leave this session and say, I think the facilitator said I need to close my business. Not saying that. You need to pray about it, consult with others. But sometimes if we take a loan, it may prolong the life of our business, and when really it's time for it to close. And so you need to consider these things and talk to other wise people to discover the way forward for you. There are 5 things that banks will look at in terms of funding loans. And so the first is collateral. They want collateral, something that is of value that you pledge to the lender, that if I don't pay this back, then therefore you have the right to come and take this. Oftentimes land is used as collateral, and people have to present the land deed. And of course the challenge is if something happens, you can't pay it back, and this is family land, it can become very, very sticky. And so you have to make sure that you have a clear title, that you have permission to use that title, and of course the formal banks will make sure that all of that is in order. But for you, you also want to be very sure that before you rush into something that you have the full capacity to pay it back. Other common things are vehicles and providing the title for the vehicle, other machines, the title or the documents for those, and collateral is very important. It helps the investor, the person who is giving you the loan, to feel safer. They will offer you a contract, and so it's important that you read that contract because it's a legally binding agreement that you are entering into with the lender. And be careful. Some of those contracts can have a lot of small small print about different fees that will be added in for the taking of the loan. And so we have met with a number of different banks and worked with banks, and we think that we're getting the loan at this particular interest rate, which is a good interest rate, but there are all sorts of other fees that get added in that you aren't aware of until you receive your loan amount and you see all the things that were taken right off the top to cover that amount. And so make sure that you see that contract fully. A cosigner is something else that they may ask for you to have, and that is if you don't have enough credit yourself, you don't have enough of a history with the bank or with the institution, they may want somebody to come alongside to say, if this person doesn't pay, then I will pay for that person. And so it's often somebody that needs to be able to show that they have some collateral themselves, that they have some capacity to pay that back. Of course, interest is the cost of borrowing money, and you want to be sure that the interest is something that you can afford. The principal is one thing, paying the cost of the loan, but that interest is what's going to drive it up. And there are some loans that they will give you a flat interest rate. and then others that have a declining interest rate. And so the interest rate will slowly go down as you are paying the loan off. Others are flat all the way across the board. And you need to look at those details. What is the different amounts, and what is it that you would prefer to have, which is better for you? A penalty, of course, is if you fail to make a payment on time, you will be charged a late fee. Sometimes those late fees are within a day. Sometimes they're within 5 days. Make sure that you know and that you understand. And again, as part of your management, that you have managed the loan, that you're setting money aside on a weekly basis to make your monthly payment on time. And then, of course, in the contract are the terms for everything involved with the loan: your principal, your interest, the due dates, the length of the loan, the payment amounts, collateral expected, and so on. So there are 5 C's of credit that the bank is going to look at, or that institutions will look at. The first is your capacity. What is your capacity, ability in order to repay the money? The second is the capital. How much capital do you have? The more capital you have invested in your business, the better, since you have more to lose and will work harder to repay it. This one is where people can sometimes want to change numbers a little bit, and that is why when we go through the section on the balance sheet, we're going to talk about how to assess the capital that you have, because you may have a vehicle for your business. Maybe you bought it at $10,000, but you bought it 8 years ago. It's no longer worth $10,000, and so the bank and you, they need to assess the capital that you have and what its actual value is. The collateral, of course, I mentioned, is the third C of credit. The condition, what are the terms of the loan that specify how the money will be loaned out and repaid? And then the fifth one is character. How you are perceived by the lender. The lender will evaluate your honesty, your integrity, your dependability, and your background. More and more countries I'm seeing are beginning to have a central database system for loans. Means if you take a loan from a microfinance institution and you don't pay it back, your name is entered into that system as having received that loan, and others will look it up. Prior to the beauty of the internet, we could do that in isolation, and that information didn't necessarily get all over. But now that reputation, if you have defaulted on loans, it will follow you. And so you need to understand that your integrity is at stake, your reputation is at stake, but it also will affect your future as well. And so be sure that your character is one that is beyond doubt, that people will be able to trust you, and that you will maintain that integrity in how you are managing that loan. So remember this about loans. Loans come in many different shapes and sizes. If you don't like what you are being offered, you can shop around and look for other options. Do not take the first one that's offered, again, if somebody else might make you a better offer. Remember that loans are not free money. They are borrowed. They must always be repaid. When you borrow a loan from a lender, the obligation to repay that loan belongs to you. When you borrow a loan for your business, the funds do not belong to you. They do not belong to your family, and they should not be used for personal reasons. Another thing that I have heard as I've done this work is that sometimes churches have asked for a tithe on a loan. And of course, I want to recommend that you never do that. And the reason is because a tithe is something that comes out of the first fruit. It's something that has been produced and multiplied, and you give it back to God. A loan is a liability. It is a debt that you owe. And if you pay a tithe on a debt, you're going to be worse off because you will not have that money in order to be able to help it to multiply. You will be operating at a deficit. And so sometimes pastors, when I have asked them, why are you asking for a tithe on a loan? They say, well, it's because we know that now this business person has this loan. We won't see them for some time, and so we better get the tithe up front. And of course, if you are planning on doing that, if you have just received a loan and you're not going to be going to church for some time, you can at least let your pastor know, I'm going to be busy, but I am going to be faithful because I give, because I have been given so much. And Christ's love compels me to be generous, but that I will not tithe on a liability, because that is not going to help me. That's going to make me further in trouble. Remember, the loan is not yours. It belongs to the business. You tithe. The business doesn't necessarily tithe unless you've set it up, which is tithing from the profit of the business, not a liability. Remember that your interest is often figured annually, but it is quoted for payment on a monthly basis. So keep that in mind as you are looking at the numbers. Just like a business, most lending institutions are in business to make money. They want to be self-sustainable. They want to meet the demands for the community. And so remember that just as you are needing to repay them from your business, they also are doing a business. And when they make a demand for you to pay the agreement that you agree to, remember they are not the enemy. They are doing their job, and they are also trying to fulfill the work that God has given them to do. According to the Bible, we must be faithful in repaying debt. And so be very careful. Don't step into waters unless you are able and willing to carry it through. And if ever somebody says to you that you can receive this loan and don't worry, they won't ask for you to pay it back, don't be foolish to follow into that, because really, if you agree to a loan, you are to pay it back. If that person ends up wanting to give it as a gift, that's on them. But once you sign something and you make an agreement, it's as if you are signing that before the Lord, and it is a matter of integrity for His business, as it is His owner. It is His business. He is the owner, and you are the manager. So, as you will look in your workbook, you will see a financing plan questions and things that you need to think through. What does the business need in order to grow? Where will that source of funding come from? I imagine that maybe you have a great marketing plan, and that will take some funds maybe to do that. Maybe you have an economic goal that's going to grow the business, and you need a new machine to do that. What will be your source of funding for that? How will you receive those funds? My encouragement is that you continue to go slow and steady in order to grow your business, and that you are willing to take the risks, but make sure that you have thought it through and talk to people who can advise you financially if numbers aren't your favorite thing, to make sure that you are doing the right thing at the best time. So my prayer for you is that you will grow, that you will prosper, that you will flourish, and that you will do it in God's way, and that you will continue to challenge yourself to use your brain more than your back, to be disciplined with your savings, so at the end of the day, your business flourishes for your customers, for the employees, for the community, for you and your family, and ultimately for the glory of God. Thank you so much for being with us this session. God bless you, and we'll see you next time.